This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When we first introduced group relief, as you'll see here at the beginning of this section 4 on group relief, what did we say about the group relief that would be available? It allows companies within, of course, as we've learnt and defined what is an effective 75% group, to transfer any part of a current year trading loss of one such group company, the surrendering company, the loss-making company there, to set off against any part of another company's TTP, the claimant company's TTP. But here, of a corresponding accounting period. We assume, as is mostly the case, of course, in real life, that all of the companies within that group will prepare accounts to an accounting year end date that is the same. Whatever date they choose, all group companies have the same date. So they all have profits or losses of the accounting year ended on exactly the same date there. And on that basis, we are matching like with like. There is 12 months worth of loss of the loss maker, and here are 12 months worth of profit for each of the profit makers. Any part of that loss against any part of those profits. But what I left you with at the end of our very extensive previous session was example 3 here, where what we had, once we had changed the information from example 2 here into example 3, such that Z plc prepared accounts to the 31st of March 21 rather than the 30th of June. And for that period, for Z, year ended March 21, it made a loss. Here in the question, Z plc's trading loss for the year ended 31st of March 21. And we were then introduced to the fact that B Limited, its subsidiary company, or one of, rather than having prepared accounts for the same year end, the 31st of March 21, had only started to trade on the 1st of October 20, but then prepared accounts for what was then a 6-month period to the 31st of March of 21. So what we're saying is that B Limited had a 6-month period to the 31st of March 21 in which it made a profit. Z Limited's loss was for a year ended 31st of March 21. So they've got the same accounting period end, there's just one problem. This is 12 months worth of loss, and this is only 6 months worth of profit. So all of that 6 months worth of profit is coterminous, it corresponds with the year ended March 21. It doesn't fall outside of that accounting period. All of the 6 months to March 21 are within the year ended March 21. Therefore, all of that 6-month profit, whatever that TTP figure is eligible to be group relieved. All of the claimant company's TTP is eligible to be group relieved. But can we then have access to all of that loss in a group relief claim? And the answer is no. Those two periods don't correspond in full. This is a year ended March 21. This is 6 months to March 21. Therefore, how much of that loss of the year ended March 21 would now be eligible to be group relieved against the profits of the 6 months to March 21 for B? And obviously there's a 6-month corresponding period. So for Z, we will take 6/12 of that loss, and whatever that comes out to, any or all of that loss could be group relieved against that entire 6 months of profit. So 6/12 of the loss corresponds with the 6-month profit period. That's the comparison that you make. And all it would mean is, whatever that loss figure was, you take 6/12 of it, and that would give you the amount of loss to go against the profit for B Limited's 6 months to March 21. That point was made within the notes Group relief to be limited will be restricted to 6/12 of ZPLC's trading loss for the year ending March 21, and the set-off will be against all of B Limited's TTP for its entire 6-month period to March 21. There were no numbers there, and often it's easy to understand things with numbers. So if we say here that ZPLC, the loss maker, had a loss for its year end March 21 of 200,000, and B Limited had its profit of 120,000 for what was the 6-month period to March 21. What have we just said? All of that profit period corresponds, it's a part of that year ended March 21. So all of the profit of the claimant company is eligible to group relief, to be group relieved rather. The problem is Z, in as much as only 6/12 of its loss of 200, therefore 100,000, is eligible to be group relieved. So you can only take 100,000 of the 200,000 loss, and because that is less than the profit of 120, all of that 100 could be offset. Clearly, if that profit figure for that 6-month period was less than 100,000, then that would be the smaller number. That would be the maximum amount of group relief available. So if this was 80,000 instead of 120, the amount of loss, 100, is bigger than the amount of profit within the claimant company. So then the maximum group relief would not be the 100,000 loss, it would be the £80,000 profit. Okay. What we now look at is a situation where we have, as we referred to them, non-coterminous accounting period ends. In that example, both companies had the same accounting period end date. It's just that one of them only started to trade, or indeed only joined the group partway maybe through its accounting bit. It only had that 6 months worth of profit that correlated to the period of loss. Up here we said, in this note B here, where the accounting periods of two group companies are different, then group relief will be restricted to the corresponding or coterminous period. It is therefore necessary to time apportion both the loss-making period and the profit-making periods to calculate how much loss may be set against how much profit in each accounting period. So here, for example, we may have A Limited owns 100% of V Limited, so clearly both in a 75% group, and therefore they can group relieve one with another. Doesn't matter who is the profit maker, who is the loss maker, group relief is available. We tell you there that the parent company, A Limited, has a trading loss for the year ended 31st of December 2021 of £200,000. But V Limited, its wholly owned subsidiary company, for whatever reason, examiner doesn't have to justify it has prepared accounts to the 31st of March, year's end 31st of March. So that means that the loss-making period of the year ended December 21 corresponds partly with the year ended March 21 and partly with the year ended March 22. So you need to time apportion how much of that loss of 200 corresponds with the year ended March 21 and the year ended March 22. And that will be how much loss may go from the loss-making company A Limited to be group relieved against the relevant profits of V Limited within those accounting periods. Whether you can relieve all of that loss will then be dependent on the amount of profit within the claimant company. So we need to match those corresponding periods. So the year ended December 21 is how much of that falls within the year ended March 21. Well, we've got, of course, 3 months. So 3/12 of that loss can go against 3/12 of that profit. There's the corresponding period. Of the year ended December 21, only the first 3 months of it correspond with the profit-making companies the year ended March 21. That means that the remaining 9 months worth, we've got times 3/12 and times 9/12, of the loss of the year ended December 21, that will correspond with, as we have it here, although it doesn't seem to want to write now, try clicking a button. There we go. That corresponds with 9 months of that year ended March 22, so that will be times 9/12. So the loss-making period spans 3 months of the year ended March 21 profit period, 9 months of the year ended March 22 profit period. So 3/12 and 9/12 of its loss can respectively go against 3/12 of the profit of the year ended March 21, 9/12 of the profit of the year ended March 22. For each of those periods, whichever is the lower number, you'll notice here that I've given you a loss of 200,000. That is less than 300, but it's more than 160. So in one of those comparisons, one of the two sets of corresponding periods, we'll have that the loss is the limiting factor. It is smaller than the amount of profit. And the other one, the loss is bigger than the amount of profit available in the corresponding period. And therefore, it's the profit that will limit the amount of group relief available. So if you could just work those calculations for me, you may already have done them in your head, of course, there, but just work those numbers and then we'll have a look at a further example together. Okay, let's see if we got our time apportionments correct. I hope we have after that introduction to it. So what group relief will be available within V Limited for the 2 accounting periods that are straddled, that are covered by the loss-making period of A Limited? Well, we have 2 accounting periods of profit for V Limited, the year ended March 21 and the year ended March 22. Within the year ended March 21, how many months of that profit period corresponded with the loss maker's loss-making period? That we agreed to be 3 months. So 3 months worth of the loss made by A Limited, 200,000, would mean that £50,000 of loss is surrenderable, is eligible for group relief. Against 3 months worth of what is a profit, of course, for V Limited of 300. Well, that's 75,000. Therefore, what is the maximum amount of group relief available? It's the lower of these two numbers, and that there, therefore, would be £50,000. We have £50,000 of loss that corresponds against the profit-making period in which we'd made 300,000. The corresponding period of profit is therefore 75. So all of that 50,000 is eligible to group relief. Remember, we're talking about the maximum group relief available. You are still free to choose to make a lesser claim if you so choose. That's down to you. These are the maximum group reliefs available. 50 is less than 75. All of that loss may be used. In the 9 months of corresponding period between the loss maker and the profit maker, for the profit maker's year ended March 22, we can take 9 months of the loss, which was 150, but put it against just 9 months worth of a profit of 160, which is 120. We can see that 120, therefore, is the smaller number. So although there's £150,000 worth of loss available to be group relieved here, the maximum claim is restricted to the profit eligible to receive that group relief, the claimant company's available profit of £120,000. We would then consider, well, that will still leave some £30,000 of loss. What can we do with that? If, of course, it can't be used by the subsidiary company here, again, just going back, A owned 100% of V Limited. A is the loss maker. V Limited, the sub, is the profit maker. If it can't be used by the subsidiary, then it can still be used within the loss-making company itself. I gave you the trading loss. There may have been still a TTP for the company for the period. It may still have had other sources of income, interest income, property income. It may have had capital gains, all of which would form a TTP for that period. And therefore, we can claim in our current period. If we do that and there's still loss left over, you can carry back 12 months, which would usually equate to the previous accounting period. Or, of course, if there's still loss left over, we don't have to make that current or carry back claim if we don't want to. But if there's anything to be carried forward, it could be carried forward within the loss-making company A to go against, of course, future total profits. But if it went to the next period and there was no total profits in that period, there were no profits, then as there would be no brought forward claim available within A Limited for A Limited's brought forward loss into that subsequent period, then it is still unused loss brought forward. Well, that too would then be eligible for group relief to the subsidiary company, presuming it is, of course, still a profit-making company, presuming there's still some loss left over. So a lot of flexibility, a lot of reliefs available. The typical objective testing question, though, is something of this nature, where we're asked to work out what are the maximum amount of loss reliefs available for the specified accounting periods. We now know, look at the coterminous accounting periods, how many months of the loss-making period correspond with how many months of which two profit-making periods, time apportion both the loss and the profits. The smaller in each of those comparisons is the maximum amount of group relief that would be possible. If we turn our attention now back to our study notes, and here we've got example 4, and that's going to bring together the issues that we have just discussed there, where we have non-coterminous accounting periods, with the issues that you had in the homework example 3, where although two companies have the same accounting period end date, they both haven't traded within the same group for all of that period. So what we've got to do, therefore, is to time apportion either the profit or the loss to the amount of corresponding period that exists, just like we did with that example 3. So what is the question asking you to do? Compute again the maximum group relief claims available to J Limited and Z Limited, though you may want to turn that to the American pronunciation of Z, in respect of Beyoncé's loss of $240,000. So there's the object of the group relief claims. Beyoncé's made a loss of £240,000. Just a small amount for Beyoncé, of course, there. £240,000. And we're going to work out what the maximum group relief claims are available to J Limited and Z Limited. Here's the information. You're going to read through that. You're going to look to see Beyoncé, the loss maker, prepares accounts to the 31st of March in each year, has two wholly owned subs. So yes, wholly owned, 100% is clearly more than 75%, so group relief is available. J Limited and, let's go American, Z Limited there. J Limited has been owned for several years, but prepares accounts to the 30th of June. So non-coterminous accounting periods. Therefore, we need to see what is the loss-making period and which profit-making periods does Beyoncé's loss-making period correspond with, so far as J is concerned. With Z Limited, Z Limited started trading on the 1st of January 21 and made a trading profit of $50,000 in its 3 months to March 21. Beyoncé, remember, also prepares accounts to 31st of March, so they've both got the same accounting period end date. But Beyoncé will have a loss of the year ended 31st of a trading loss of $240,000 in its year ended March 21, whereas Z Limited only started trading on the 1st of January and therefore had a trading profit of 50,000 in what is only a 3-month period. What can you match with what? Where's the corresponding period? As we know, Beyonce had the trading loss of 240 for its year ended March 21, while J Limited was also a profit maker, a claimant company, had a TTPs of 160 for the year ended 30th of June 20 and 280 for the year ended 30th of June 21. How much of those profit-making periods corresponds with the loss-making period of Beyonce? Again, you can put it in a little diagram, get the figures down, look for the matching periods, do the calculations. I'd like you to have a go at that now. Take your time to get it right there. Make sure you are matching like with like for any corresponding period. Over to you. Okay, well, let's see how you got on with example 4, therefore. The issue was that one of the companies here within the group, it was Beyonce itself, had made a trading loss of £240,000. It had made that loss for the year to the 31st of March 21. We had 2 wholly owned subsidiaries. One had been a continuing subsidiary for several years, but its problem was it prepared accounts to a different date, the 30th of June instead of the 31st of March. So we had non-coterminous accounting periods. We had to match like with like. How much of the loss-making period corresponded with how much profit of the profit-making periods that it spanned. We had a further problem in as much as the other subsidiary company in the question had only started to trade part way through what was Beyonce's accounting year to the 31st of March 21. It too, the new sub, prepared accounts to 31st of March, but it only had a 3-month period to that date. So what I did first of all here was to just map out what we had, which I've just talked you through. This isn't, of course, necessary in terms of you answering an objective testing question. Just here's just for purposes of further explanation of what we're doing. We've got all that loss of 240 for the year ended March 21, and we've got 2 companies, 2 wholly owned subs, within which it may be group relieved. The first issue, if we look at Z or Z if you prefer there, it only started to trade on the 1st of January 21, so it only had a 3-month period to the 31st of March. All 3 months of that profit-making period, in which it made a profit of 50,000, fall within the year ended March 21. So all of that profit is eligible for group relief. So the limiting factor is then going to be potentially the amount of loss that is available for loss. So that is a 3-month period. So what is 3 months worth of that loss-making period? That would be 60,000. In which case we have more than sufficient loss available to group relieve all of that profit. Clearly the maximum group relief is the £50,000. The loss available is 60. If you choose so to do, you could remove all of that £50,000 using 50 of the 60,000 available loss. So that's Z dealt with. J has traded throughout the loss-making period of Beyonce, but has 2 of its own accounting periods of profit that span that loss-making period of the year ended March 21. Firstly, J's year ended June 20, and then the year ended June 21. Beyonce's year of the 31st of March 21 began on the 1st of April 20. Therefore, the year ended 30th of June 20, we've got 3 months worth of that profit period corresponds with 3 months worth of the loss-making period. We already know that 3 months worth of the loss-making period is £60,000. What is 3 months worth of the profit-making period? 3/12 of 160 is 40. So with regards what the maximum possible group relief is, remember there's a finite amount of loss available, but what is the maximum loss that could potentially be group relieved from Beyonce into J against its profits of the year ended 30th of June 20, 3/12 of 160, well that's going to be £40,000 as we've seen there, and that is less than 60, so that is the maximum group relief. The year ended March 21 loss-making period, well, 9 months of that corresponds to J's year ended June 21. So what is 9 months worth of that amount of, what have we got, profit there against what is 9/12 of that loss of 240. The loss, 9/12 of 240, that's going to be what, 180 amount of loss. Clearly we're doing 9/12 of 280. That's going to be a bigger figure in an objective testing question. Therefore, you don't have to go any further. There's your 180,000. That will be the maximum group relief. But 9/12 of 280, what's that going to be? 210, I think. So there's more than sufficient profit available to absorb that loss. So there are your maximums. Now, of course, you couldn't group relief against all of those profits because they're available to be relieved. There is more profit than there is loss available to go into the group relief actual claim. But those are the maximums that would be available, up to a ceiling of the loss of 240,000. But how the group chooses to use that loss, that's entirely up to it. All we've done here is to work out what the maximum claims would be in the profit makers for the relevant accounting periods of the profit maker. That again can be seen here in terms of the work that we've shown in the answer. Both Beyonce and Z Limited prepare accounts to March, but Z only started to trade on the 1st of January 21. Therefore, only 60,000, 3/12 of Beyonce's loss, corresponds with Z's profit period. However, will not be a problem as Z's profit is only 50,000 and will therefore represent the maximum group relief available. Job done. J Limited's accounting period is not coterminous, and therefore both its profits and Beyonce's loss must be time apportioned between the corresponding periods. As we've said, 3 months worth of Beyonce's loss was 60,000, and that corresponds with 3 months of J's profit for the year ended June 20. 3/12 of 160 is 40,000, and therefore the smaller of the numbers, the maximum group relief is 40. That left 9 months of Beyonce's loss, corresponding with 9 months of J's profit for what would have been the year ended June 21. So 9/12 of the loss, £180,000. The profit was bigger at 280. 9/12 of that was 210. So again, the smaller of the two. There is your maximum group relief available. So it's not difficult work, it's just messy. There's different amounts of profit or loss, there's different accounting periods, there is a company starting to trade part way through one accounting period. You need to match the relevant periods and then, whatever is a corresponding period, do, where appropriate, the relevant time apportionments. And when you get an amount of loss, an amount of profit, whichever is the smaller, that represents the maximum relief available. Okay, going back to your notes now, one final thing as regards group relief. It probably won't be an issue, but I'll mention it just in case. And it's not going to make any difference, by the way, to what you do. But the claimant company, the company that's getting the benefit of some other company's loss, the surrendering company, may make payments to the surrendering company for the benefit of the group relief. Any payment up to the amount of the loss surrendered is ignored for corporation tax purposes. So if you are told here that in a question that the claimant company, the company benefiting from the group relief, some other company is giving up its loss and presenting it to reduce the profits of the claimant company, saving, therefore, that company that amount of tax. Those profits would have been taxed at 19%. That will not now be a liability of the company. It's been removed. Well, it is perfectly reasonable in those circumstances that a payment therefore may be made, usually equivalent to the benefit of the tax saving. So we've just surrendered £100,000 of loss. from the surrendering company to the claimant company. The claimant company has, say, used that 100,000. That has reduced its profits taxed at 19%. So what you'd routinely see in a situation such as this is that the claimant company, who's got now a £19,000 lower tax liability as a result of this group relief claim, pays back the benefit of that tax relief, 19,000, to the surrendering company. That tax loss was a valuable tax asset. The surrendering company, had it not given it up this period, could maybe have used itself partly this period, and maybe if not, then in the future, if not to a carryback claim. It had value. It's only reasonable, therefore, to pay back the benefit of that tax saving in the claimant company to the surrendering company. You don't have to do that. Again, it's up to the group to decide. All of these are in a 75% group. The subs will do whatever the parent company says. But you don't have to do it. But if you do it, don't be put off by that statement within a question, because it will have no impact in terms of the group relief work that you do. It has no impact. It's not an issue. It is outside of the taxation system. The payment made by the claimant company to the surrendering company is not an allowable expense to reduce its profits. The receipt by the surrendering company is not income to be charged to tax. The payment and receipt, if it is made outside the tax system, has no effect on the corporation tax computation. But there is one final and substantial area, but probably not as substantial as the issues and the mechanical work that we had to do with group relief, that deals with chargeable gains groups. Now, as ever, the first thing that we'll have to do is to define what we mean by a 75% group, and that only gets interesting when dealing with indirect sub-subsidiaries. Again, we've stated a 75%. The note here will explain what we mean by that 75% group. I'm telling you that because you're going to read through these sections prior to the final session, where I'll take you through this and we'll work examples to illustrate. So what do we mean this time by a 75% gains group? Once we know who's in, which, as I say, I will illustrate next time. Once we know who's in, then so what? What does it mean? And a bit like at the beginning of our study of groups, we said that membership of a group gave rise to certain rules where HMRC say, if you do this, this is the way it will be treated. No other option. You can't decide how it will be treated for tax purposes. This is what will happen. That's what we have here. But what we also have are claims, elections that may be made by a company or companies here within the group to improve the tax position of the group. Like group relief. That was an election, a claim made. It improved the tax position of the group as a whole. The group benefited by the ability to use a loss of a loss maker, not just within that loss-making company, but to share it amongst the other relevant 75% group members, reducing their profits. The tax implications, therefore, are stated here, where we are told about what a rule is, and also then what the relevant claims and elections are. Now, one of these we've made mention of in our, again, introduction to the chapter on groups, whereby you are able, group companies can make an election such that any part of a capital gain or loss incurred by one company may be treated as arising in another company. And you may recall in our lecture we said if one gains group member has made a capital loss, another gains group member this period has got a capital gain, without this election, the loss in the loss maker would have to be carried forward, because capital losses can only go against capital gains, and if there isn't a capital gain this period, you cannot carry back, you can only carry forward. So the loss would be carried forward in the loss-making company, while the gain would be taxable in the gain-making company. Well, wouldn't it be better to be able to match? And there is what is sometimes known as a matching election that is available. And that matching election, as we said again back at our earlier intro, and now will be seen in detail here, you can match any part of a gain against any part of a loss. You can deem any part of a gain or loss made by one gains group member to have been made by any other gains group member. So you could move the loss to the gain, or the gain or any part of it to the loss. We could match gains with losses, allowing immediate relief, at least to the extent that there are gains available, for the loss sustained, preventing therefore the situation where the group is paying tax on a gain in one company and is being denied the use of the loss in another and being compelled to carry it forward until such future time that a capital gain arose. This will allow the gain and loss in the two different companies in the same gains group to be matched. There is one further election which goes back to our capital gains relief study, and we will know that when it comes to corporate tax, there's only one capital gains relief that is available, and that is rollover relief. Now make sure, before we see you next time, that you've reminded yourself about how rollover relief works. We've only seen it before in a single company, where what happens is a company disposes of a qualifying business asset and makes a chargeable gain thereon. The usual asset in question, of course, is land and buildings, property used within the trade. But such a disposal is made. But if the proceeds are reinvested in another qualifying business asset, make sure next time you know the period within which the reinvestment must take place. Then, so long as all of the proceeds of sale have been reinvested in the cost of the other new qualifying business asset, then all of the gain that arose on the disposal can be deferred by a claim for rollover relief. Understand that, remind yourself what that situation was for an individual company. The company made the sale, made the purchase, rollover was available, full rollover if all of the proceeds were reinvested, partial rollover if we only reinvested some, but not all of those proceeds. Remind yourself of that. And all that will happen here is that instead of the sale and the purchase both being made by the same one company, now one gains group member does the selling, a different gains group member does the buying. They're both in the same gains group. Therefore, the capital gain made in the selling company can be rolled over against the base cost of the asset bought within the buying company. So it doesn't have to be the same company doing the selling and the buying. One gains group member sells, a different gains group member, or indeed members over a period of time, buy. Group rollover relief is available. Right. That, therefore, is nothing new other than what I've just said. It doesn't have to be the same company. So you can prepare, you can read through this, go back to the issues mentioned within it, like the rollover relief issue there, and also go back to the introductory lecture where we mentioned about capital gain in one company, capital loss in another. That would be useful, and then we can more easily and more quickly go through our final session together in this chapter on groups, dealing with gains group membership.